All right, guys. So we are started recording here. And I'm already ahead of slide by accident. Kind of go back here. Let me see here. All right. So this is the Catalyst team here. If you don't know me, I'm Jared Huseman here. And this is going to be a 1 hour presentation, maybe a little less, maybe a little more, depends on questions and answers. And we're going to talk a lot about how the wealthy, like President Trump, use real estate to offset and avoid paying taxes, or at least try to push them down the road as much as possible as well. We can't always avoid taxes completely, generally speaking, but there are ways we can offset them or at least mitigate them as well. As we're going through, feel free any given time, guys, do a couple of things. One, please mute yourselves unless you have a question. If you do have a question, please do one of two things. Either raise your hand. If you don't know how to use Zoom, raise your hand, or just put it in the chat as well. Myself, my assistant, will be monitoring the chat as much as possible throughout this as well. So just ask questions as we're going. If you have any questions, we'll do our best to help answer them as we go. We are going to have dedicated Q&A at the end as well here. So that's just kind of a couple of quick housekeeping things as we get started here. And again, as I said, I'm Jared Huseman here, president of the Catalyst team. I'm a CCIM. If you know what that means, great. If you don't, no worries. Just as a fancy title as well. So first things first, I just want to say thanks for joining us today, taking an hour out of your day to learn more about taxes, real estate, how we can use real estate to offset taxes as well, investing in yourselves, your own education, your own knowledge base as well. It's always our highest return on investment. I always say invest in yourself, invest in your teammates, and invest in marketing, the three highest returns. You're all doing that right now, investing in your own knowledge yourself as well. So I applaud that and just want to say thanks. And because of that, I want to say at the end of this here, by the end of this PowerPoint, you should be able to hopefully talk to an accountant of some kind and drastically reduce your taxes by anywhere from 10, 20, 30% as well. So that's my commitment to you guys, is that by the end of this, you're going to hopefully learn something you didn't already know and see something new that could be coming up for you in your real estate tax journey as well here. So that's my commitment to you guys. As always, some of you may have been some webinars before or not, but this is why you should trust me here. Why do you know who I am for anybody off the street? Why trust me over Donald Trump himself or Grant Cardone or anybody on the web? So why would you trust me here? Well, here's kind of my experience as an agent here. I've been in real estate commercial agent for over 10 years now. I've produced over $100 million of transactions for clients now. The average client as a buyer has a 26.95% IRR, internal rate of return, and my sellers average about 96% offer to ask ratio as well. This has all been done by myself. No other agents on my team. It's just me and a couple of assistants as well. I have had a few agents also produce. However, that's not included in this number as well. This is just me, myself, and I. Over 80 transactions right now over the last 10 years. So had a few run-ins with taxes, 1031s, that kind of thing as well. As an owner, I've been a real estate owner longer than I've been an agent. 15 years now, more than 15 years of real estate experience in ownership. I'm also third generation real estate entrepreneur. My parents are developers, owners. My grandpa's an owner as well. And because of this, I've completed deals in development. I've done my own development deals. I've done redevelopment deals. That was a fun one. I've done residential houses. I have done apartment buildings, ownership and brokerage. I've done industrial ownership. I've done retail ownership. I've done office ownership. I've owned all the assets and I've tried a little bit of everything overall. So been there, tried it, done it here as well, and try to get feedback as much as possible on that. 5 things that I have learned in real estate is that there are 5 ways to make money. The first is the most common one, cash flow. We all want cash flow. We all want passive income. The second one is we can actually use leverage. Leverage actually helps us make money in real estate. We'll talk about a little bit as well. We have debt reduction through leverage. We have appreciation. And then we have tax savings, which is, of course, going to be the theme of this whole presentation here, is how we help offset and avoid taxes as well here. So the first and foremost one to make money is the most obvious, cash flow. We're going to talk about these real quick here, just high level, briefly go through them before we jump into our taxes here. So cash flow is the most obvious thing investors want. If you know what cash flow is, the most common way is take gross income annually minus your expenses annually equals your net income on an annual basis. And then your net income minus any debt payments. And that is your annual or monthly cash flow. Really simple, really basic, I know. But it's just, again, a good way to get started off with the basics here. Vince Lombardi always came out and said every year, this is football, guys. This is what they were doing. They were starting with the basics. Basics are always a great way to build on and grow from as well here. So we have cash flow. We have leverage. Leverage, of course, is used in two ways, loan to value or the debt service coverage ratio as well here. Now, LTV allows you to borrow up to, this is the max, 5-to-1 ratio, up to an 80% loan to value and a 20% equity, 5-to-1. You take $1, leverage it up times 5, it's 100. That's a 4-to-1 actually kind of number. It seems 4-to-1, but it's actually 5-to-1. The other way banks will allow you to borrow money is on a DSCR, debt service coverage ratio. This essentially allows you to borrow $1 of debt for every $1.20 of net income you make. If we go back to the previous slide, gross income minus expenses equals your net income. That net income will allow you to borrow money up to a certain range. Now, what banks will do, this has changed a lot, especially over the last 2 years, is banks will lend on the lesser of either amount, either a 1.2 DSR or, generally speaking, an internal LTV that they set. It can be 70%, 80%, whatever it may be. But again, they will use those terms interchangeably as well. So for many years when rates were low, people just said LTV, loan to value, and they would lend on the value of either 70 to 80%. Depends on what terms it was. In 2009, it was 70%. Afterwards came 80% a while. It kind of varies. But right now, with interest rates being high, more commonly banks are looking at debt service coverage ratios that they will lend on more than LTVs because they want to make sure that the property can perform and create the money it can to pay back that debt. So that's how we use leverage. If we do use leverage, we use debt as well. One of the best ways to create income that people don't talk about as much is one of my favorite ways, actually, which is actually debt reduction. Because at the end of the day, what you're using is you're having a tenant or a business of some kind pay down your debt. It's phantom cash flow. They're paying down the principal mortgage every month and their payments as well, and in your payments to the bank. This is not talked about very often, but it is one of the things I love the most. In fact, I actually look every year at how much interest I pay to the bank, which is no fun, and then how much debt my tenants have paid off for me to increase my net worth as well here. And this is why I call it phantom cash flow. We all forget about it sometimes here, but it's really fun to look at because it can add up to thousands, tens of thousands, even $100,000 as our residents and our tenants pay down the debt to help us own property over the long term here as well. The third way we can make money is appreciation. Appreciation also has another word called inflation. You may recognize the symbol to the right there, that picture. Stuff happens, well, appreciation happens, or inflation happens, depending which word that you use. They can both be used in some ways interchangeably here. Over the last 40 years, inflation or appreciation has averaged 2.8% annually over the last 40 years. As we all know, it's happened a little bit more aggressively recently. It was pretty light for a while there in 2009 and 10 as well here. Now, you can also, of course, force appreciation in properties by increasing the income, by fixing properties up as well, or just being a good market. Here where I'm located, Des Moines, Iowa, we have seen appreciation because we're a high growth market. We're seeing a lot of factors contribute to our growth. We're seeing jobs come in. We're seeing people come in. That's forcing our appreciation, forcing our values to go up as well. So you can also force appreciation. You can buy into the right market. We're not talking about that very much here as well, but that is a way you can also increase your income here. Now, I love movies here. So if anybody's seen any of these webinars before in the past, I quote movies a lot here. So looking beyond, I'm going to quote Star Trek, beyond the third movie here, it was kind of okay. It wasn't as good as the first one, but looking beyond, go beyond the next thing as well. Real estate can be more than just cash flow, more than just debt pay down, more than leverage. Of course, it can be all about how you offset and defer your taxes, or at least help eliminate them in all the ways. Now, we're going to go into some basic strategies here, and hopefully we get some more intense strategies a little bit as well, some more intense strategies what's looking at. So we're going to talk about the 4 main tools that real estate works best to offset or avoid taxes here. So the 4 core principles that we use, the Catalyst team recommend it here as well. So for all those out there, and this is being a little political here, I'm not going to get into this too much here, but anyone wants to say tax the wealthy. We always say tax more, tax the wealthy. This is just an example of some of the taxes we all pay any given day. As you can see, income taxes, we have over 6 of them. Federal tax, state tax, local tax, payroll tax, Social Security tax, Medicare. self-employment, unemployment, sales, use tax, exercise tax, luxury tax, et cetera, et cetera, et cetera. There's a lot of there. Property tax, real estate tax transfer, capital gains tax, and estate tax. So those four are on the right, those five on the right, excuse me, are very specific towards real estate, but we also have the ones on the left. If you're still tired of taxes, we also have corporate income tax, franchise tax, gross receipts, gasoline tax, vehicle registration, toll roads, tourist, hotel taxes, license fees, and to basically just say we have a lot of taxes. When you actually break it down here, sometimes I had a professional that break it down to me. If you really look at it, for almost every dollar we create of income, about 95 cents of it can go out to taxes if we don't find some way to offset it. We have a lot of taxes in our country here, despite what the people may or may not think. So we, of course, did a big thing back in the day. We had the tea, the Boston Tea Party here. It's the bad imagery here, but we threw some of the tea in the ocean in the there because we were tired of this. The rich avoid tax. They offset these 30+ ways of taxes. They always have. We have since the dawn of our country tried to avoid taxes. Again, we hated the tea tax. We still hate taxes here. So this is gonna be how we do that here. And of course, we use real estate to help avoid and offset all of these taxes here. So the first strategy here, we're gonna get into this now, getting into the weeds. And again, as we're going forward here, feel free to ask questions here. Feel free to unmute yourselves, or feel free to throw the questions in the chat here as well. I want to be interactive here, not just me always talking here as well. So first strategy of how we avoid taxes. Well, it's pretty simple. It's depreciation. What is depreciation? Depreciation is the process of deducting the wear and tear and the deterioration, obsolescence of a property over its useful life. So basically what it just means is that a property is going to naturally get worse and worse just because it is being used. That's simply what depreciation is. And because the property is going to get worse, the government has decided that they want to give us a benefit for owning that building that is slowly deteriorating every year as well. So on the right here is actually a really great picture. I really like how this applies because it shows what we can and cannot depreciate. We can depreciate equipment, vehicles, and buildings. We cannot depreciate land, intellectual property, and other things like that as well. Why? Because those things will continually give us value. Land will always be worth something because it is a finite resource. Intellectual property, our ideas, they're still there. They're not going to go away anytime. And then, of course, goodwill, all that will not go away as well, which goodwill is essentially just, donations. So we can also, I want to make sure we point this out, for anybody who owns or operates their own real estate business, any equipment related towards real estate can be depreciated. Now, this mostly is just the real estate itself. We can look at refrigerators, appliances. We can look at washing machines. We can look at equipment such as trucks, vehicles, that kind of as well. Equipment can be written off, computers as well. Vehicles, again, I mentioned vehicles as well. Another great source of depreciation for anybody who runs or utilizes real estate, especially a real estate business owner operators type as well. Great source of depreciation as well. And we can depreciate vehicles usually at a faster expense than actual real estate itself, which we'll go into that shortly as well. Land is not included in this. Land is always excluded in a depreciation schedule. And again, as I said, it's because land always is going to have value of some kind. It may have less value in certain areas. So for example, a land in Manhattan is going to be much more valuable than the underlying land in Iowa here. Land values will differ across markets here. Again, in this case, New York City, Manhattan versus Iowa here. If you are buying specifically to help offset taxes, you should very much take into account the consideration of what is the land value and the building value of where you're buying here. If you really want to maximize that depreciation of that building here, you definitely want to take into account what is the underlying source value of that land, because that land is going to have more value, especially in high density areas like Manhattan, New York City, potentially LA, Washington, D.C., etc. as well. And you cannot depreciate land here. So take that into account for anybody out there who's looking to offset taxes in purchasing here. Standard depreciation for residential properties is 27.5 years. That actually works out mathematically to 3.63% of the building value every year, year over year. After you've hit 27.5 years, 28 years, 29 years, you would then lose that depreciation schedule, and they assume at that point the building needs to be replaced in some capacity here as well. This is for residential. For commercial, it's 39.5 years. They assume that commercial was built with higher standards essentially, or just has less wear and tear on the building here. 2.56% of building value every year over 39 years here. Now, I'm not getting into the details of this as well, but when you do buy a property, you actually only get about 6 months originally of the first year of that. And then it actually does its full 39.5, actually 38.5 years. Then you get the other half year on your final year as well. It's kind of a metric here. It's kind of a little bit wonky and weird. Consult with your accountant, your CPA for that as well here. But generally speaking, 27.5 years to 39 years overarching. Your first year and your last year of ownership will be a little bit different because most of us don't typically buy properties January 1st and then sell December 31st. So your first year is a little bit wonky on how most people will account that for that. This can be used to directly offset and reduce your income and your taxes. Just simplified answer is, so if you are buying a building for $1 million, well, actually in a second as well. So building for $1 million valuation, residential, you would get a $36,300 taxable write-off. Year one, if the building's value is $1 million, the land excluded, $25,600 if it was commercial here. On the right is if you are a single filer here as well. Some on this call may be single filers, some may be joint. We'll go in a second here. So this would be potentially your tax savings if you are making an income between $48,000 and $103,000. You can create tax savings of $8,000 to $5,000, etc., all the way down here as well. As you can see, if you are making over $600,000, it can be potentially up to a $12,000, $13,000 taxable event that you can actually save on your taxes as well. So it can be very big if you're a single filer. And then looking at that as a married filing jointly as well. Again, the same numbers here, just married filing jointly as well, the different tax revenue streams as we continue to go up and up in value here. What I do want to point out as well is, generally speaking, this is a generalization here, and again, consult your accountant, your CPA, but generally speaking, the more money you make, the more you are going to need real estate to offset your taxes here to help get you into lower tax brackets and to really make a difference here. Generally speaking, this is a joke. This is only something I told one time to tell a story. If you bear with me for a second, all of you. I remember one time I was in a room full of meeting and everybody was trying to figure out how do they avoid taxes? How do they avoid taxes more and more and more? And finally, the person, the head of the room that was teaching the class, he said, anybody in this room, raise your hand at this time if you make over $250,000. And about in that room of 100 people, 5 people raised their hand. And he said, okay, now you 5, we all have a real estate problem or a tax problem. Let's go solve it. You other 95 people who make less than $250,000, you have an income problem. Go focus on making more money and income. We'll solve the tax problem later. So generally speaking, I've always remembered that here, and I remind you as well. Generally speaking, if you are less than 24%, if you're in that 22% or less of income, you probably should focus on making more income first, worry about avoiding taxes later here. Taxes are always going to be there, I promise. But again, focus on making more income. Focus on growing the top line, not necessarily bottom line. So that's your first strategy, was depreciation as well. Pretty simple, pretty basic here. Now we're going to go into second strategy as well, which, if you haven't heard of it, is what we call a cost segmentation or accelerated depreciation strategy. So if we look at the picture here, straight line depreciation means that we are going to reduce the property's value by 2.5 to 3.6% every year over a 27.5 or 39-year period. With accelerated depreciation, we can actually front load a lot of those cost savings right up front. What do we do by doing that? What we do is we actually are able to reclassify each individual component of the building at a different life expectancy. So let me explain here. If we are looking at a commercial apartment building here, so apartment buildings are taxed as commercial when they're bigger than a certain number here as well. The concrete in that apartment complex will probably last 40 years, maybe longer. Depends on the concrete, how it's maintained, also its location. However, the carpet inside of that apartment complex is probably only going to last 5 or 6 years. What a cost segmentation strategy does is it actually goes in and looks at each individual component inside of a building and then reclassifies it as a different life expectancy. With that being done, you can then make that depreciate over a shorter timeline and front load a lot of those costs here. This is also why, I'm gonna go to the second getting a little ahead of ourselves. Office buildings and apartments are really great for cost segmentation strategies. because they tend to have a lot more things that will wear and tear more often than something like an industrial property, which I also have owned as well, which is typically more just metal and concrete as well. But by reevaluating a lot of the components inside of a building, again, we can push forward a lot of those costs up front here. And the IRS lets us do that. Now, what I would say is accelerated depreciation is kind of like getting your dessert first. So yes, you get all these savings up front, but remember, you also means you're gonna get less savings after a certain amount of period as time here. In the beginning, when you do this though, most buildings you can get 20 to 40% of the building's value within the first 5 years of ownership here. So going back to the example of $1 million property, you're gonna get about a 36,300%, $300 or so write off your first year with the $1 million. In this case, the same $1 million property, you could write off 200,000 or 400,000 in your first few years, as opposed to just 36. It drastically pushes all the savings ahead, which is really important for anybody who is making a lot of money. They need to offset their taxes. As I just said, though, this is going to front load your tax savings, which means less tax savings in year 6 or beyond. Now, this is really, really important to talk about here. It's one that most people don't talk about. Is you could actually has a helpful, but basically, be careful about using cost seg. What we use short-term cost segmentation, because it could actually bite you in the long run. We're actually going a little bit here as well. One thing that drastically also changed in terms of cost segmentation strategies was the Trump tax cuts of 2016, 2017 here. So what Trump did is actually allowed increased accelerated depreciation. So think accelerated depreciation on steroids. And again, what he did, you can front load usually over the first few years. Well, what he allowed was you to actually do 100% year 1, and then it eventually phased out here. So as of right now in 2025, you can take 40% of your cost savings right up front here. So using that $1 million building example here, traditional depreciation, $36,300. That's standard $1 million residential property. With accelerated depreciation, let's say you can get to 40% over the first 5 years. That's $400,000 over a 5-year period, or about $80,000 per year. Again, drastically changes all that. Because of this Trump tax cuts, that same $400,000, you can take 40% of that $160,000 as an offset this year alone. That's still in place here. So again, to think about it here, before the Trump tax cuts, you could have gotten a standard depreciation 36,000, and then after the tax cuts, you could have gotten maybe, or actually before taxes, you could have gotten maybe 80,000 per year. Still today, you can get 160,000 on this example here, and that's just kind of talking through things here. But it was drastic. It was huge. It really spurred a lot of real estate here. There is talks about trying to reinvigorate this program here as well. Now, what I want to point out is that as the Trump tax cuts do burn off, and they are burning off, accelerated depreciation will still be there. Cost segmentation is still a strategy. It's still used by the senators, the congressmen, the rich. It's probably not going to go anytime soon, but the burn-offs are starting to burn off as well. So just be aware of that here, and that might be happening as well. Now, I kind of mentioned this earlier here, but I want to point out again, multifamily works best for cost segmentation strategies because it has more eligible components. It has flooring, it has cabinets, lighting, carpet a lot of times, windows. Just more and more things will deteriorate in an apartment complex than a retail or industrial building. Also, if anybody's ever had residents or tenants, I can promise you a resident or a tenant will beat up a property. I don't care whether you have A class, B class, C class, or any kind of classification under the sun. You could have Z class for all I care. Tenants will beat up the property here. And the more you beat the property up, the more you can take depreciation. So multifamily tends to work best. Office space works pretty well as well. But that's a great way to offset and get a lot of faster write-offs is multifamily, which is why a lot of our clients choose to invest in that, especially high net worth clients as well. And again, you can save hundreds of thousands of dollars right now on this, especially with the Trump tax cut, the 2016, 2017 out there, can drastically offset it. As the example, we just used $1 million building today. If you do a cost seg, 160,000, give or take, offset your taxes. We're going to go a little more detail on that, what that is. This is the word of caution I want to talk about here now. So as I said earlier, this will front load a lot of your tax savings here. However, just because you're front loading taxes doesn't mean you're not going to pay them eventually here. The tax man likes to always get his way. And so understand that if you do a cost segmentation study, let's say this year in 2025, and you take that 40% right off the bat, that $160,000, and then you were to sell next year, remember you just front loaded your cost savings of your taxes from 36,000 standard up to maybe 160,000 today. So you just saved 130,000 in taxes. If you sell next year, the government could come in and recapture some of your taxes that you did not pay and make you pay it then at a higher rate. And so I want to point out that cost segmentation studies are great. They're a great tool. I've seen a lot of clients use them. I've also seen sometimes clients use them at their own detriment here because something came up and they had to sell in the first few years and it ended up not being so advantageous towards them. This is usually the first 5 years. If you're on a property longer than 5 years, it usually doesn't matter that much here, but I generally say a word of caution. If you're going to own a property less than 5 years, be careful about utilizing cost segmentation or cost segs essentially here. This is really important for anybody again thinking this long term here. And so I really want everybody to plan long term. I know of at least one client right now, as a story real quick. If they were to sell for today's value, they would almost owe more in taxes than the overall profit, and it works out to about $7 million of taxes because they just pushed taxes off so long, and it's almost worth more than the entire building. So just be careful of how you utilize these tax savings. There's a common saying, buy until you die, which we can go into later. But this is why I think me, and I think even my CPA on this one, I'm going to give a shout out to Brian here, Brian Morrow. We always favor strategy over tactics because anybody's easy to do, go do a deal. But anybody can buy property, anybody can invest, but it takes strategy to do it effectively and efficiently here. So I always give the example of Warren Buffett. Anybody can go out and buy a share of Coca-Cola stock and say you are an investor just like Warren Buffett. Why is Warren Buffett the best investor of all time? Because he has a strategy. He doesn't just go out there and be tactical and just invest in one stock. He does it strategy over a long, long period of time here as well. So I always want to strategize with clients. This is why we do these webinars, or are doing more of these webinars as well now, is because we want all of our clients to strategize their tax savings, not just go out there and blindly do what someone says. Anyway, pushing on. The third strategy here of real estate tax savings is what we call a REPS, real estate professional status here. Now, what this is allows rental losses to offset your ordinary income. This is a very, very powerful tool. Requirements here: to be a real estate professional, you have to have 750 plus hours of activities within the real estate field in any given year, or you have to have over 50% of your time spent doing real estate here. You have to have material participation in your properties or be actively managing your properties in some capacity, whether that's an asset manager, property manager, showing assistant, whatever it may be. You have to be actively working your real estate business. It's also going to be a real estate agent like me, realtor of some kind. Your spouse can qualify if filing jointly here. This is why, this is kind of a joke, but I'm just telling you seriously, guys. This is why so many people have their spouses, husband or wife, get their real estate license as a real estate agent. Because if they become a real estate agent and they effectively make most of their income as a real estate agent, they can start to utilize the real estate professional status to offset their income. So you'll see this is partially a joke with builders. You'll see doctors, attorneys, accountants, whatever it is, go have their wives or their spouses or husbands, vice versa, go become real estate agents, make a lot of money from that source of business, but they use it more for an offset of their taxes. So it's a really powerful thing here as well. Now, what this looks like in action here, if we actually were to put this together here, if we combine real estate professional status with a cost segmentation status, it can become really, really, really powerful as a tax shelter for all of us here as well. So what we can do is we can track hours and group activities under IRS election. Make sure you're tracking your time as a real estate professional here as well. We're going to go into that a little bit more later as why. But here's an example of what it look like. If we take $1 million multifamily building here, we just talked about a little bit ago, and we do accelerated depreciation on that here, and we get a lot of that cost savings right up front, 40% or so. So we have $400,000 of depreciation because we did a cost seg. The Trump tax cuts allow us to use 40% of that this year in 2025. That means we can have $160,000 of depreciation automatically against our ordinary income. So if we take 160,000 depreciation against an income bracket, I use 24%. That's right around 300,000 or so, 320,000 of joint filing accounts receipts. We can create $38,000 of losses. So we take 300,000 minus $38,000 of loss, creates a taxable income of 261,000. What that does mean is you save about $10,000 in taxes. So instead of owing $70,000 in taxes, we now owe $62,000 in taxes, and that works out to about a 12.8% reduction in taxes. Now, I'm not getting into the math of how this all works, but essentially what you're doing is you're taking your tax bracket from 24% down to about 12-13%. It's a little bit kind of hard how to say it and explain it all, but what this helps doing again is help getting your taxes at a lower bracket as well here. And this is how we utilize cost segmentation strategies with the real estate professional status to help offset drastically reduce your taxes, especially with the Trump tax cuts. Again, any questions, feel free to ask it here, but this is exactly what the wealthy are doing. And I want to point out again too, whenever you have really specifically new buildings, new developments, they work phenomenal for getting a lot of cost segmentation done as well as real estate professional status. Any questions so far about the three strategies? Depreciation, cost segmentation, real estate professional status. I'm assuming no questions so far. The fourth strategy we use, many of us have used as well, this part's kind of fun, is we get into 1031 exchanges. What this basically means is we can exchange one thing for something else as long as it's quote unquote a like kind exchange. This allows us to defer capital gains by reinvesting in a like kind property here as well. It's great for scaling without triggering taxable events. Many of us on this call probably have done these before, participated in them, whatever it may be. But it allows us to get into bigger properties. So we can use depreciation and cost segmentation to drastically reduce our tax bill. As we pay down that bill, that $1 million comes down to, let's say, 200,000. Then we can then sell that building for way more money. Let's call it $2 million. And then we can go buy another property and continue to reset and lower those taxes as well. Essentially what we're doing. And so the way I describe this really simply is it's kind of like Monopoly. You go out, you buy 4 green houses. Literally, you can go out and buy 4 houses, and then you sell them and you 1031 into 1 red hotel. That is essentially what a 1031 is. It is exchanging 4 houses for 1 red hotel. And then eventually you exchange 1 red hotel for maybe a larger purple hotel or 10 hotels, whatever it may be. But that's essentially what a 1031 is in its very simplified form. Now, there are, of course, rules around 1031s. First things first, you have 45 days or so to find a replacement or identical property here. You can find up to 3 properties as well. And then you have 180 days to exchange or close into that property here. And while you're doing this, all the money has to go to a third-party intermediary. You cannot touch the money. You cannot look at it. You can just think about it here as well here. And I want to point out as well is that 1031s, a lot of people will feel threatened by this deadline. What I want to point out is for anybody looking to sell, remember, this is 45 days from the day you close the property. So if you have a long due diligence and inspection period or a long closing period, you could have up to 6 months to a year sometimes to find another property to go out and look for and buy as well here. So again, I know these timelines seem very tight and quick, and they are, and they can be, but just remember that you can also do this over a long period of time as well if you need. So just remember that that does happen as well. What I also want to point out is that most people forget about, but there's actually 4 types of exchanges. This part people most time forget. Most people know of the standard exchange, which is the delayed one. There actually are 3 other types of exchanges. The one is the other one is simultaneous exchange, which basically means if I close on Monday, I also close next property Monday as well. It's not really much different than a delayed exchange. But if done correctly, you can do a construction exchange, or you can do a reverse exchange. Now, reverse exchanges are fantastic because you can actually go out and, in theory, this is a little bit more tricky in practice, and we can help you walk through this here. But in theory, you can go out and actually buy a property first, put it under contract, and then sell your own property and then reverse into that property as well here. So if you can go actively out there and find, let's say, a retail building or an industrial building, apartment complex that you really like, you could put it under contract and say, I'm going to buy this as a reverse exchange, and then come back and sell, list your own property as well. That you were looking to 1031 into that as well. So one of the most more uncommon taxes of 1031 that I don't think people utilize enough, quite honestly. That I think it's one of the best forms of a 1031. Everyone wants to do the standard, but the reverse is one of the best ways, in my opinion. Another way to do a 1031 exchange is called a 721. This is an advanced level of exchange. Most people forget about this or don't know about it. A 721 exchange is just like a 1031, and the picture there probably describes it best. What you actually do is you actually will essentially sell your property to a REIT, a real estate investment trust. And in exchange for that real estate investment property, that REIT will give you or issue you, excuse me, shares in their company as well here. So for example here, if I was going to sell $1 million apartment complex building to a REIT, and that REIT was now went from 9 million to worth 10 million. Let's just use quick numbers. It's worth 9 million now. I sell my building to them, it becomes worth 10 million. They will now give me a 10% ownership in simplified math inside of their REIT. Now I own 10% of shares in their REIT. This is a great way for owners who are owner operating, owner managing their properties to reduce their headaches, their day-to-day management as well. It's also called an UPREIT as well, because you up into the REIT, you go up into it as well here. You have to exchange into a real estate investment trust though. It's also called there's also things called DSTs, Delaware Statutory Trust. Very similar to REITs, operates the very same way. Just a little bit different here, but it does defer taxes like a 1031. And it does provide liquidity and diversification a little bit here as well, because now instead of owning one property, you have partial ownership usually in multiple properties or a lot of them as well here. Again, one of the 1031 exchanges that's on the exchange levels that's not talked about enough, I don't think, but it can be utilized as 721s, or again, also known as a DST, Delaware Statutory Trust as well here. And it's ideal for long-term owners looking to exit their active management, active ownership as well. Now, I said as well that there are some legislative changes possibly coming up. Currently, we're in 40% for the Trump tax cuts. There's potentially bills out there trying to restore this, make it more. Just be watching that as well. There's been a lot of politicking going on lately here, so I'm not going to even try to guess what's going to happen tomorrow. So that could happen as well. There has been a lot of talk over the years, too, of trying to get rid of 1031 exchanges. It's been talked about forever. I don't see it ever happening. Too many of the senators, congressmen use it themselves. I don't think it'll actually change anything, but there have been talks about putting caps on 1031s, about how much money is actually eligible for here. Because if you do it right, you could have millions upon millions of dollars deferred till later dates as well here. Also, the real estate professional status, a lot of scrutiny on that right now because it is such a great tax haven. People are using it so effectively, for lack of a better word. IRS looking into that a lot more heavily here. So track everything in relation to your real estate professional status, because again, they are heavily looking at that here, trying to really look at that, specifically your hours, or again, your income as well, but definitely track your hours on that if you can. So in summary, your kind of tax toolbox for the 4 things all together is utilize cost segregation studies plus bonus depreciation, and then utilize your real estate professional status, put those 2 combined. We use that with a 1031 exchange as well, continue to go up into bigger and bigger properties the whole time, offsetting our taxes. And overall, you're going to get a huge tax strategy with real estate here. So again, utilize cost segregation, use bonus depreciation, reduce those tax bills, use your rep status, reduce them even more, continue to pay down that debt from tenants, continue to have appreciation on that property, then sell it, roll into a bigger property, do the same thing over again, continue to repeat over and over again. And over about 10, 20 years, you're going to have a few $1 million probably to play with if you use effectively and with the right strategies here as well. Now, one final thought here. This is kind of a bad picture. It's kind of a little blurry here. But if you are also a business of any kind, if you are going to be a real estate professional, at that point you have your own business. Why not use your business to also utilize the tax savings that a business gives you? If you're going to be a real estate agent, real estate professional, why not have expenses like marketing, like rent, like insurance, maintenance, utilities, travel costs, meals, entertainment, that kind of thing? Why not use your real estate professional status not only as a way to offset your taxes on a daily basis, but also use your business to help offset the normal cost expenses of your just normal life? Again, I don't want to use them in normal life in a certain sense. You can't just go out there and buy groceries with your business. There are certain expenses that are allowed or are not allowed, which talk to your CPA accountant about that as well. But that can be another highly effective way, which is way beyond the scope of this presentation, to talk about how you can utilize your business to help offset your taxes as well here. So that being said, we are at it for question and answer. I do have my CPA on the line that I work with, Brian Morrow, as well, for any maybe other questions. He can get into a little more details on things. Otherwise, I'd also say consult your own accountant, your own CPA. I don't want to sit here and tell you what he should or shouldn't do here. But any questions all about real estate and taxes, things on the pipeline, things coming up? Not all at once. One thing, I'm just going to mention this here because it's worth mentioning here, at least for all of us on the line here. I'm assuming most people here on the call here are somewhat based or have somewhat familiarity with Iowa, just because that's our typical point as well. Earlier, you saw that I talked about all different taxes we have. We have income tax, federal tax, local tax, sales tax, etc. There have been bills inside of the Iowa Congress within the last year, actually, to drastically look at property taxes. It's not in the construct of this webinar to discuss that, but there have been looks at how we could potentially reduce property taxes for people inside of Iowa. And in a simplified answer, it ended. Congress went out without them having a solution done. But I will say, based upon the last solution that was looked at, it does look like the people who will pay more taxes under the new bill potentially will actually be multifamily and residential. It's actually geared towards reducing commercial tax liabilities more than else as well. So if anybody that owns residential or apartments, which is taxed like residential, will probably face the most taxes in the potential increase in bills. Just something that's not in the scope of this webinar, but it is worth talking about because it does relate to real estate and taxes. Any questions at all about taxes? That covered all super well? Not enough? If anybody does want to go deeper, again, this is my contact information here. I can give referrals out to CPAs, cost segment firms, 1031 intermediary exchanges, DSTs, etc. As well, happy to just talk to anybody. You can always text me, call me, or email me. Either way, I'm usually pretty responsive. Give me about 24 hours or so, I'll get back to anybody here on the call. With that being said, I'm just going to leave it open for any Q&A. And if anybody wants to jump off early here, be respectful of your time. We still have about 10 minutes left or so. Is there anybody in the slides? Yes, we can get these slides to you here. Me and my assistant can work on that. Also, we are going to most likely post this to our YouTube as well. So if you want to see a recording of this here, we'll post to our YouTube as well. You can rewatch the recording and get any more spots you want to look at and review as well. With that being said, I'm going to do also